new to this channel, please make sure you subscribe. I am your accounting tutor and I am here to see you succeed in your accounting courses. This is related to financial accounting, so your principles one, and then I'll do some videos on principle two if you request for it. As always, I'm going to share the notes, or if you desire these notes specifically, please go ahead and email me at dr.samuelakin@gmail.com, and I'll give you these notes so that you can practice or you can go over them on your own time. Again, just email me at drsamuelakin@gmail.com. Also, if you feel like you need one-on-one tutoring, I will try to make myself available as much as possible because my goal is to see you win. I am tired of so many students failing or not moving forward in their graduation because they cannot pass accounting one. That's the purpose of these videos. And so if you feel like you need one-on-one tutoring, go ahead and email me at dr.samuelakin@gmail.com. So today I want us to do a problem. Remember, as I've mentioned before, all of my videos are structured to be how-to videos. This is not a lecture. I trust that you are going to class. I trust that you have a really good, competent, and excellent professor. So I am not going to lecture. I just want to focus on how to do problems. That's what this is all about, trying to really get you to know how to do things. Now, in order to do the exercise or to kind of walk you through the concepts, is going to require some background information, which may come off as a lecture. So if you feel like you already know this information, you can just go ahead and two speed or just skip on to when we actually do problems. You don't need to, go and look for another video that gets to the point. You can simply skip in within this video to get to the point. And so we're going to jump into it today. We're going to be doing exercise around, this is very important, understanding accounts. Okay, understanding accounts. Accounts are very, very important. If you do not know how to, or if you don't understand accounts, you will struggle with doing journal entries. The ultimate goal is trying to do journal entries, but in order to do journal entries, you have to familiarize yourself with accounts because accounts are what makes up a journal entry. So let's talk about an account. What is an account? You want to write this down. An account is a specific it's a specific tool that we use to track transactions. So I'm gonna write that down. I'm gonna just put it here. So an account. So let me just put that in bold. Account, specific tool used to track accounting transactions. That's what it's really all about. It's a tool to literally to track accounting transactions. Do you remember in elementary school when you were learning how to count, right? What were some of the things that your teacher used to try and help you to understand how to count? The teacher may have used fingers, right? Like they'll say 1 plus 1 equals 2, right? That was a way, that was a tool to help you to know how to count. Or they would put up, like, maybe two objects, like 1 plus 1 equals 2. Or they'll have you draw whatever have you. These are just tools to help you get to the ultimate reality, which is counting. The same is true with an account. An account is a tool to help you get to the larger focus, which are the financial statements, right? So again, account is a specific tool used to track accounting transactions. So we ought to familiarize ourselves because these accounts, also you want to note, they help, excuse me, they help to organize accounting transactions. So they help us to organize accounting transactions. What do I mean by that? So when we look at a transaction, and again, you can look at a transaction if you go to my previous video where we were talking about, I think it's journal entries made easy. I'll probably see if I can link it in here. But if you look at that video, you'll see that there are these accounts and they're helping us to organize our transactions. Transactions, like I said in the previous videos, in Journal Entries Made Easy, there are lists of, just a whole bunch of random stuff. But these accounts here, they help us to organize our thinking and to organize these transactions. So that's why accounts are very important. Okay. So that's what an account is. Here's what you also need to know, which is very important, is that accounts are subsets of the big three. So they are a subset of the big three. What are the big three? We talked about this in a video entitled The Accounting Equation Made Easy. And so, what are the big three? The big three are assets, liabilities, and equity. Very important. Remember, we talked about the accounting equation. We said that assets equals liabilities plus equity, right? So we said that this is the accounting equation. Everything stems from this accounting equation, right? So we said that, or excuse me, these accounts are a subset of of one of these three. So there are asset accounts, there are liability accounts, and then there are equity accounts. Okay, thumbs up. Cool. All right, so what are accounts? They're specific tools to track accounting transactions. They help us to organize accounting transactions. Accounts are a subset of these big three. So there are accounts for each of these. And then next, very important, is what we call normal balance. Okay. So each account, they have a increasing side. Okay. So there is a increasing side, or there is a way, I'm gonna put it this way, there is a way to increase the account. Okay. There is a way to increase an account. Okay. So when we're looking at transactions, there are going to be multiple transactions where we either are increasing the account or decreasing the balance on the account, right? So there are ways to increase an account and decrease an account. And those ways are called, you want to take note of this, debit or credit. Okay, so debit or credit, it is a it's a tool or a sign. That's a better word. Debit and credits are a sign that determines whether or not we are increasing an account or decreasing an account. Okay, so again, remember that with these accounts, there is a way to increase it, and that's either a debit or credit. So let's, with that information in mind, I'll come back to this. Let's go over some problems together to see if we can do this together. Okay. So the first one is land. So land is an account. So the question is, what type of an account is this? What type of an account is this? Is it an asset, liability, or equity? Give you a second. Absolutely right. Okay, so it's an asset. Asset. Okay, why is this an asset, Dr. Akin? Remember, it says assets are resources a company possesses and owns. Okay, assets are resources that a company possesses and owns. For sure, if a company buys land, it's theirs, right? They own it. They are the landlords. They are the landowners. So it's definitely an asset. So then the next question is, how do we increase? So when we see the word normal, just think about increase. Okay. So how do we then increase this account? Should we debit it or should we credit? So for asset accounts, you want to write this down. We debit. So to increase a asset account, we debit. Okay. Then more to the point about land, is it a current asset or is it a long-term asset? Okay. Current or long-term? Well, the question is, how do we determine what is current and what is long-term? How do we determine what is current or long-term? So you want to put this in your notes. If it's a current account, it's going to be 30 days or less. And when I say 30 days or less, it means become due 30 days or less, 30 days or less, or we owe them 30 days or less, or we have to pay them, excuse me, 30 days or less, or we will receive payment from a customer 30 days or less. Long term is a year or more, right? So if we're using this asset for longer than a year, we're going to call that long term, right? If we use the asset for less than a year, we call that short term. Okay, so want to write that down, less than a year. Okay, we call that short term. Short term. All right, cool. So based off of that, do you think we'll be using land for a year or more or less than a year? Well, absolutely. We're going to be using land for a long time. So that's going to be a long-term asset. Long-term asset. All right, cool. Let's go to the next one. Cash. Is cash an asset, liability, or equity? Cash is a asset, right? Why is cash an asset? Because we possess it, it's in our bank account, and we own it, it's in our bank account. Now, with asset accounts, how do we increase assets? Remember, we increase with the debit, okay? We increase with the debit. Now, what you have to learn here with these normal balances and the increase and decrease, I say it to my students all the time, there is no rhyme or reason. This is the law. Okay. This is the law. There's no arguing. You can't argue. You don't care about your opinion. We just don't. It is what it is, right? Like when you're driving and it says, beware, speed limit is 50 miles per hour. If you go over 50 and you get pulled over, the officer is not going to care about why you're speeding. He's not going to care that you're speeding because you're late for work. He's not going to care that you're speeding because of, you're trying to catch a flight. Officer is not going to care about your opinion. Officer is not going to care about your circumstance. Officer just cares about if you obeyed the law. The same is true with debits and credits. It's just the law. Doesn't matter about our opinion. Doesn't matter about if we think this is smart or not, if this is convenient or not. It does not matter. It is the law. Whenever we have an asset account, if we want to increase it, we will always debit it. Okay. All right, moving along. Now, is cash a current or long term? Remember, current is a year or more, short term, less than a year, so 30 days or less, whatever. Do you think it's current or long term? Think about it. Cash. It's definitely going to be current, right? It's going to be current. Why would it be current? Because chances are you're going to be using your cash often, right? So it's going to be current. Now this next one is legal expenses. Legal expenses. Now, is that an asset, liability, or equity? Asset, liability, or equity? This is a this is equity. Okay, very, very important. So remember what I said, and if you watch the journal entry explain video, I talk about how there is a basic. So there's a basic accounting equation, all right, and then there is a complex or expanded accounting equation. Okay, so there is a basic, which is assets equal liabilities, or there's an expanded, which is assets equal liabilities. Here it is, very important. Uh, Plus common stock minus dividends plus revenue minus expenses. Okay, so this is the expanded accounting equation. Again, trying to fit it in one frame. Okay, perfect. Yes, so this is the expanded accounting equation, right? So in other words, what we're saying is equity is made up of common stock minus dividends plus revenue minus expenses, right? So when we look at legal expense and it's an equity right here, to increase it, you're going to debit as well, okay? So to increase legal expenses or expenses for that matter, we're going to go ahead and debit it. Now, the question is it current or long term? Legal expense for sure is going to be current. It's going to be 30 days or less, right? Because usually an expense is something that you have paid within the operating cycle, okay, within the operating year. Okay, so we're going to give that current. All right, moving along is prepaid insurance. Now, what is prepaid insurance? Prepaid insurance is when you pay for something that you have not yet utilized. I want you to think through this. Prepaid insurance is paying for something that you have not yet utilized. Okay. So, what's an example? Like we're looking at insurance, right? So, I can buy a car and I can pay for 24 months worth of insurance. Okay. Now I want you to think about it. If I paid for something that have I have not utilized, would that be an asset, liability, or equity? It will absolutely be an asset. Why would it be an asset? Why would it be something we possess and own if truly we gave up money for that insurance? Well, it's going to be an asset because at any given point, if we were to cancel our policy, they must return that money to us. You see? So it's technically still our money, although it's in somebody else's possession. Because legally, at any given point, we can ask for that money back. We can cancel our insurance and they owe us however much we have not yet utilized. So that's an asset. Okay. And how do we increase an asset? We debit. Okay. Prepaid insurance is again something that is going to be current. It's going to be less than a year, typically. All right, so let's move on. The next one is accounts receivable. What is accounts receivable? Again, you can refer back to my previous video where it's called Journal Entries Explained or Journal Entries Made Easy, something to that effect. I go over the definitions of all of them extensively, so I encourage you to go back. But accounts receivable is money they owe us. Okay, so money they owe us. I mean, is that an asset, liability, equity? It's definitely an asset because they owe us money, right? So how do we increase an asset? We debit it, okay? Is this going to be current or long term? This is going to be current as well. The reason why it's current is because usually we want people to pay 30 days or less. We want people to pay 30 days or less, okay? All right, let's move on to the next. This is some type of touring or tour services. Let's put touring. I think that's easy. So touring services, say for example, we give guided tours, in an amusement park or something. That would be an example of touring revenue, touring service revenue. So what type of account is this going to be? This is going to be an equity account. Remember, the accounting equation is assets equal liabilities, or excuse me, assets equal liabilities plus equity, and equity is common stock, dividends with revenue, and expenses. So we can definitely put that as equity. Now, here though, for revenue specifically, we're going to credit to increase. So you want to write that down. We want to credit to increase. Why are we crediting the increase? Because as you see here, there's a plus in revenue. So we are crediting to increase. Very, very important. This too will be a current, this will be a current account. All right. So unearned revenue. This is a tricky one. Unearned revenue. You would think that unearned revenue is the same as this type of service revenue, but nothing can be further from the truth. Truth. Unearned revenue is a asset. It's an asset. Okay. Well, excuse me. It's not an asset. It's a liability. It's a liability. Okay. It's a liability. So why is unearned revenue a liability, Dr. Akin? I see the word revenue. I thought revenue means money coming in. Well, it's true that revenue means money coming in, but what's attached to it is that it's unearned. So there are situations where people would pay us for work that we have not completed. It sounds crazy, but it happens all the time. People are paid for work they have not completed. Say, for example, if I cut grass and I want to cut grass for Georgetown University for an entire year, Georgetown would probably want to pay me up front on January 1 for the entire project. So that way they don't have to, be bogged down with constantly trying to pay me throughout the year. They can just pay me one lump sum payment in January 1 and be done with it, right? But here's the thing. Here's the thing. It is a liability to me because although I possess the money, someone else has legal rights over that money. Okay, let's think about a concert. I think that would be better because you all like, concerts. Let's say Queen Bee, okay, Beyonce. She goes on tour. What is the first thing that happens? She goes on social media. She says, "Hey y'all, go run it up on Ticketmaster. Go get your tickets." So what do you all do? You go to Ticketmaster, you go and you flood Ticketmaster, the site crashes, and you hope to get a ticket You finally get the ticket. Now look, you paid Beyonce for work or performance she has yet to perform. You see? So here's what happens. Although Beyonce, she is, her bank account holds your money, Beyonce must give you that money if she does not perform. You see? So you legally still own the money, although she controls or she is in possession of the money. So that's a liability, right? It'll be a liability for her. We call that unearned revenue. So again, unearned revenue is receiving funds for work that you have yet to complete. So that is a liability. How do we increase a liability? We credit that thing. We credit that thing. And this too would be a current. This too would be current. All right. Let's keep it moving. Next is services revenue. Services revenue. So services revenue is just like the one we see here. So we can just literally copy and paste everything, right? It's equity. What makes it equity? Because the expanded equation says that equity is made up of common stock dividends, revenue, and expenses. So it's equity. And we increase revenue by credit, and that's going to be current. Next is equipment. So let's say they purchase or a company purchased a MacBook, right? That would be some type of equipment. Okay. So what would that be? A company purchases something, an equipment. That's definitely going to be an asset, right? So we're going to come here and put asset. And how do we increase the asset? We debit. Okay. And this equipment is interesting because this equipment actually can fall under long term, because we can be using this equipment for 10, 15 years. We'll talk about it later down, but there are certain assets that have a useful life. Okay. So that useful life is very critical. So we'll call this long term for now. Don't want to confuse anyone. So long term. Next is notes payable. What is notes payable? Notes payable is money we owe them on credit that we signed a contract for. Very critical. Money we owe them on credit that we signed a contract for. Some students get confused with notes payable and accounts payable. They are not the same, they're different. Notes payable deals with a written contract, where accounts payable can be any old promise. So notes payable is a what? Is it an asset, liability, or equity? Remember, it's money we owe them on credit. It's definitely not an asset. Absolutely right. It's a liability. So we're going to come here and put it as liability. And how do you increase a liability? You credit. Notes payable, you want to pay careful attention. Usually, notes payable will fall under long term. Usually, notes payable will fall under long term because usually notes payable are longer than 90 days. All right, so you want to keep that in the back of your mind. We just kind of spoke about this, but accounts payable is also going to be a liability. What is accounts payable? Money we owe them, period. Notes payable is money we owe them that we signed for, whereas accounts payable is just money we owe them, right? We promise to pay them back via invoice, so we give them the invoice, right? So accounts payable is going to be a liability. We increase with a credit, and this is actually going to be current. Okay, this is going to be current, and the reason why this is current is because usually accounts payable is 30 days or less. We want to pay back 30 days or less. Next is notes receivable. Notes receivable. Notes receivable, again, is money they owe us that we signed for, right? Again, students kind of confuse notes receivable and accounts receivable, but they're different. Accounts receivable, again, is just money they owe us, period. Notes receivable is money they owe us that they signed for. So the difference between notes and accounts is really just a contract, okay? So notes receivable is a asset account. What makes it an asset account? Because it's money they owe us. So we are in possession of it, we own it, so it's money we owe. It's an asset. To increase the asset, you debit. Notes receivable is going to be long term. Okay. So notes receivable is usually with a contract, is usually more than 30 days. Okay. Next is common stock. Common stock. So common stock is a is ownership into the business. It's a piece of ownership of a business. It's a piece of ownership of a business. Now, when you think that in mind, it's a piece of ownership of the business. Would that be an asset? Absolutely not, right? Would it be a liability? Absolutely not. But it would be an equity account. Why would it be equity? Well, because it's a piece of the business that the company owns, right? Or that the owner owns. Okay. So it'll be equity. So that's one way just by definition. But remember, way number two is just the fact that the expanded accounting equation says assets equal liabilities plus equity, and equity is common stock dividends, retained earning, or revenue and expenses. So you see common stock. So we're going to come here and put equity, and we increase common stock with a credit, and this is going to be current. All right. So hopefully we're making some headway here. Interest payable. What is the interest payable? Interest payable is when we have to pay back interest at a later time. So you want to write that down. Think is when we have to pay back interest at a later time. Okay. So this is going to be a liability for sure. It's because we owe them, right? Somebody else owns it. So we owe them money. So that's going to be a liability to increase interest payable. You credit, and this can be current. This can be a combination. Honestly, it can go either way. It can be current or it can be long term, depending on the length of the contract. Depending on the length of the contract, there's some contracts that are 30 days. There's some contracts that are 30 months, right? So it can be either or in this situation, in my opinion. Second to last is wages payable. So again, honestly, here's a pro tip. Let me just go ahead and write this. Pro tip. I'm always giving y'all pro tip. If you see payable, automatically assume. If you see pay, automatically assume liability. Okay? Automatically assume liability. If you see receivable, automatically assume assets. Okay? So this just puts you on game there. So wages payable is going to be a liability. We credit to increase, and wages usually is going to be current. We don't want to keep a long, you can't keep it long term because then no one will work for you because you're not paying people. Rent payable is also going to be a liability. Why is that a liability, Dr. Akin? Because whenever you see payable, always assume liability. This is going to be a credit, and this is going to be current as well. All right, guys. So that's all that I have for you for this video. Again, if you want these notes, again, email me at dr.samuelakin@gmail.com. Have a good day.